Hedge funds. Sound complicated? Don't worry, they're not as scary as they sound. Imagine a group of savvy investors pooling their money together. They're not content with simple stocks and bonds. They're looking for bigger, bolder bets. That's essentially what a hedge fund is, a private investment fund for the adventurous investor. These funds use a variety of strategies to try and beat the market. Think of it like a game of chess, with hedge fund managers as the grandmasters. They use complex moves and anticipate their opponents to come out on top. But unlike chess, there's real money at stake here, and the stakes can be incredibly high. The hedge part of their name comes from their initial goal, to minimize risk while maximizing returns. They aimed to hedge their bets, like a clever gambler who spreads their chips across the table. Of course, over time, hedge funds have evolved, and their strategies have become much more diverse. Now, you might be wondering, why not just stick with regular investments? Well, hedge funds offer the potential for much higher returns. They're not for the faint of heart, but for those seeking to supercharge their wealth, hedge funds can be an alluring option. Think of it like this. Investing in a standard mutual fund is like sailing on a calm lake. Investing in a hedge fund is like riding a speedboat on choppy waters. The potential for a thrilling high-speed ride is there, but so is the risk of getting tossed overboard. However, high returns come with high risks. Hedge funds are less regulated than traditional investment funds, which means they can employ riskier strategies. This can lead to spectacular gains, but also devastating losses if things go south. Not just anyone can waltz into a hedge fund and throw money at the manager. These funds are typically open only to accredited investors, meaning individuals with a high net worth and substantial investment experience. It's like an exclusive club with a hefty membership fee. Think of it as a high-stakes poker game. You wouldn't sit down at a table with seasoned professionals if you were just learning how to play, would you? Similarly, hedge funds require a certain level of financial sophistication and risk tolerance. This exclusivity is partly due to the complex nature of hedge fund investments. It's also a way to protect less experienced investors from taking on more risk than they can handle. After all, not everyone is cut out for the wild world of hedge funds. Hedge funds employ a vast array of strategies to generate returns. It's like a chef using a variety of spices to create a complex and flavorful dish. Some common strategies include, this involves buying undervalued stocks, going long, and selling overvalued stocks, going short. It's like betting on both horses in a race, but with a bit more finesse. This strategy focuses on macroeconomic trends, such as interest rates, currency fluctuations, and political events. Managers make bets on how these trends will impact various markets. It's like being a fortune teller, but with economic data instead of a crystal ball. This strategy capitalizes on specific events such as mergers, acquisitions, or corporate restructurings. Managers analyze the potential impact of these events and make investments accordingly. It's like being a vulture investor, swooping in when companies are vulnerable. This strategy relies heavily on mathematical models and algorithms to identify trading opportunities. It's like using a supercomputer to play the stock market, crunching numbers at lightning speed. Section 5. A blast from the past, the genesis of hedge funds. The concept of hedge funds can be traced back to 1949, when sociologist and former World War II intelligence officer Alfred Winslow Jones launched the first hedge fund in New York. Jones's innovative approach involved a combination of long and short positions in stocks, along with leverage, to enhance returns. Imagine a time before computers and sophisticated trading algorithms. Jones relied on his intuition, research, and a keen understanding of market dynamics to make investment decisions. His groundbreaking approach paved the way for the modern hedge fund industry. Jones's fund aimed to achieve positive returns regardless of market direction, hence the term hedge. His strategy proved successful, and his fund consistently outperformed traditional investment vehicles, attracting the attention of wealthy individuals and institutions. Section 6. Masters of the Universe, Hedge Fund Titans. Over the decades, the hedge fund industry has produced its fair share of legendary figures. These financial wizards have amassed vast fortunes and achieved near-mythical status in the world of finance. Some of the most famous hedge fund managers include George Soros, known as the man who broke the Bank of England. Soros is famous for his bold currency speculation, particularly his bet against the British pound in 1992, which netted him a cool $1 billion profit. Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, Dalio is known for his principles, a set of unconventional management and investment philosophies. His firm manages over $150 billion in assets. John Paulson made headlines during the 2008 financial crisis by shorting the housing market, a bet that earned him and his investors billions of dollars. His success cemented his reputation as a shrewd investor with a knack for anticipating market bubbles. Ken Griffin, the founder of Citadel, one of the world's most successful hedge funds, Griffin is known for his quantitative investment approach, utilizing complex algorithms and high-frequency trading strategies. His firm manages over $50 billion in assets. These individuals are just a glimpse into the world of hedge fund titans. Their stories are filled with risk, reward, and a healthy dose of Wall Street intrigue. Section 7. High risk, high reward. The allure and peril of hedge funds. The allure of hedge funds is undeniable. The potential for outsized returns is a siren song for investors seeking to grow their wealth exponentially. However, this potential for reward comes with a commensurate level of risk. Unlike traditional investments, which are subject to strict regulations and transparency requirements, hedge funds operate with a greater degree of freedom. This allows them to employ riskier strategies, such as short selling, leverage, and derivatives, which can amplify both gains and losses. Moreover, hedge funds often invest in illiquid assets, meaning investments that cannot be easily bought or sold. This lack of liquidity can be problematic for investors who need to access their funds quickly, as it may be difficult or impossible to sell their holdings at a fair price. Section 8. To hedge or not to hedge. Considerations for the average investor. For the average investor, the decision of whether or not to invest in a hedge fund is a complex one. While the potential for high returns is enticing, it's crucial to weigh this against the risks involved. First and foremost, investors should carefully consider their risk tolerance. Hedge funds are not for the faint of heart, and investors should be prepared for the possibility of substantial losses. Second, investors should thoroughly research any hedge fund they are considering. This includes understanding the fund's investment strategy, track record, fees, and manager's experience. Finally, investors should ensure that they meet the accreditation requirements for hedge fund investing. These requirements are in place to protect less experienced investors from taking on undue risk. Section 9. Hedge funds and the economy, a love-hate relationship. Hedge funds have a complex relationship with the broader economy. On the one hand, they can provide liquidity to markets and help to allocate capital efficiently. On the other hand, their speculative trading practices can contribute to market volatility and systemic risk. During the 2008 financial crisis, hedge funds played a significant role in both exacerbating and mitigating the crisis. Some funds engaged in risky lending practices that contributed to the housing bubble, while others profited from the crisis by shorting the market. The role of hedge funds in the economy is a subject of ongoing debate. Proponents argue that they play a vital role in providing liquidity and efficiency to markets, while critics contend that their speculative activities pose a systemic risk to the financial system. Section 10. The future of hedge funds. Crystal ball gazing. The hedge fund industry is constantly evolving, adapting to changing market conditions and regulatory landscapes. Looking ahead, several trends are likely to shape the future of hedge funds. First, technological advancements such as artificial intelligence and machine learning are transforming the way hedge funds operate. These technologies are being used to analyze vast amounts of data, identify trading opportunities, and execute trades at lightning speed. Second, the rise of passive investing through index funds and exchange-traded funds is putting pressure on hedge funds to justify their high fees. Investors are increasingly questioning whether the potential for outperformance justifies the high costs associated with hedge fund investing. Third, regulatory scrutiny of hedge funds is likely to increase in the coming years. Regulators are concerned about the systemic risk posed by hedge funds and are exploring ways to mitigate this risk without stifling innovation. Section 11. Wrapping it up. Hedge funds in a nutshell. Hedge funds are a complex and often misunderstood corner of the financial world. They offer the potential for high returns, but also come with significant risks. While they are not suitable for all investors, hedge funds play an important role in the global economy. Understanding the basics of hedge funds, their strategies, and the risks and rewards associated with investing in them is essential for anyone interested in navigating the world of high finance. Whether you're a seasoned investor or just starting out, hedge funds are a fascinating and ever-evolving part of the financial landscape.